Welcome to the Broken Pie Chart Podcast, episode 316. I'm your host, Derek Moore. All right. Another roller coaster of a week with a very strong close on Friday. Gapped up, very strong day, closed near the, I don't know if we closed at the high, but right around it, up about 117.5 points. S&P closed at 56.38, almost 56.39. So quite a different day does the sentiment make. And one of the things that was hopeful about the close on Friday, although we did have a strong close on March 7th as well. I don't know what it is about Fridays recently, but it showed strength. I mean, other days during the week rallied and then made new lows. The highs never sort of held. So we're seeing some things that are potentially bullish. We run you've heard Jay and I talk about it before, a quant strategy that looks at a number of different volatility-based triggers. And in that, there's several bullish things that are showing up. One is the idea of, the inverted curve in volatility. And so we look at the volatility surface, which is fancy for saying we look at the implied volatility at different expirations in SPY options. So that's one of the things we look at. We look at the put-call ratio on SPY, and we look at a standard deviation of that. When it gets to a certain level, historically, that's been pretty bullish. Look, I don't know what's going to happen. And you hear me say this over and over again. This is why we hedge. This is why we hedge. This is why we buy and we hedge, so that if you have drawdowns, maybe you don't have to worry as much. You don't have to try and time the market. You've got protection in there that looks to significantly reduce the downside. I can tell you a lot of our hedged equity strategies, where the puts are, they're already in the money, meaning they're already doing their thing. They've already sort of, quote unquote, stopped the loss to an extent there. So there's some bullish pockets. I tell you, it was interesting. And this week, Nvidia was up almost 8%. SMH, which is the semiconductor ETF, and that's a little different than the SOX index, which is more broad. SMH owns more of the bigger names, but that was up, just under 1%. S&P was down 2.27-ish%. NASDAQ was down a little under 2.46, something like that. But Nvidia goes and has sort of a week, up almost 8%. So there's these different areas now that are not necessarily all acting the same way. And that to me is a positive sign. We'll see what happens next week. The other thing we saw is that there's not going to be a government shutdown. People have talked to me, have asked me about it. I said, I don't know. They always seem to work something out or not work something out. There have been government shutdowns in the past, and typically there's a little bit of volatility around those, but eventually they sort of work things out, and, politicians do what politicians do. They get bridges to nowhere, they get earmarks, they get all sorts of stuff. But let's not be cynical just yet. I want to talk a little about, where should we start? One is, did we solve the dollar problem? And what am I referring to as the dollar problem? Well, the dollar problem is that when the US dollar gets too strong, it tends to impact earnings negatively, especially for the big global companies, multinational companies. And if we look at the dollar spot index or the DXY, which is very Eurocentric. It's very highly weighted against the euro, Swedish krona. There's some Japanese yen in there, Canadian dollar. That hit 103.72 was the recent close. Its high was in September of 22, 114 and change. And I like to say the dollar matters when it matters, but it tends to not matter as much until it gets out of the zone of insignificance, as I've coined it. And I think the fact that it's come down from its recent high, that was, January 13th, 14th. it was right around 110. So the fact that it's come down to 103 and 72, 103.72 could be good for earnings. We'll see. We're not necessarily in earnings season yet, but a strong dollar puts pressure on certainly U.S. earnings on multinational companies. The trade-weighted U.S. dollar looks about the same. That's the index I look at against all of the weighted trade that we do with all the countries. And that one's come off as well. You might remember, I think it was 22, 23. You can go back and listen to those episodes, but one of the thoughts I had was, in order for the market to bottom back then, we had to have the dollar come in. And so the dollar coming down is generally, it's pretty good for earnings, all else equal. And it never really is, but if you just isolate it that. Is there a flip side to that? Well, I also said in the last couple of weeks that the strong dollar was offsetting some of the tariffs, specifically with the Chinese yuan, Canadian dollar, some other things. So yeah, there's, that was a little bit of a contrarian idea that the dollar being very strong muted some of the tariffs and the purchasing power for companies. But I think in general, the dollar coming down is a benefit. All right, the other thing this week, the high yield spread finally started to break a little bit. And it doesn't surprise me because we sort of had a week where I think fear really started to permeate into conversations. I know I talked to a lot of advisors this week and clients who reached out. And, some clients or advisors who generally, may not necessarily call us all the time, and they're having a little bit of panic. The high yield, what is the high yield spread, first of all? The high yield spread looks at the yield on, let's say, high yield bonds against the yield on U.S. Treasuries. And it looks at this spread. Now, if we look at the spread as recently as right around February 17th, February 18th, 19th, it was right around 2.65. So what does that mean? It means that the difference in percentage points in the yield was 2.62 percentage points, or 262 basis points. What's happened recently is that yield has widened. So it's widened, not quite 100 basis points fully, but it's up to about 340 basis points, 3.4% as of the let's see when this was. Yeah, this would have been as of Friday. So it's, to put that in perspective though, August 5th, remember the Japanese yen carry trade blow up? That got up all the way to 3.93. Again, we were 3.4. And you go back and you say, well, in July of 22, it was almost 6 percentage points difference. March or February of 22 or 2020, it was almost 1,100 basis points. And, you really go back when these things, they call it, blowing out, it was almost 20 percentage points, meaning whatever the U.S. Treasury was, November of 2008, the high yield bonds were yielding, 20 percentage points higher. So if the 10-year was 1%, then high yield was yielding 21%. And so we've been saying that that's one of the things I watch, and high yield in general has not been, it's not off that much in price this year. I think it is down even on a total return basis now, but it's not blown out that much. And the reason why high yield spreads are important is that if there was a real concern in the economy of defaults and real economic weakness, you would expect to see that that reflected in the price of high yield bonds. Because basically, if there's a lot of fear of, again, defaults, economic problems, the likelihood of these companies being able to pay back their, not only make their coupon payments, but pay back at the end of at maturity, their principal, that starts to come into question. And that's why you see this blow out like you did in 2008, March of 2020. But on a relative basis, if you look at the chart, it's really not that high. In fact, I would say it was probably the lowest it's been going back to the mid to almost late 2000s is kind of how close that got. The other thing I want to talk about is the VIX Futures curve. The VIX Futures curve. So why am I interested in this? The reason why this is, we watch this is, well, first of all, to just kind of set things, the VIX that you watch on CNBC, the one they show on CNBC, is not a tradable product. The VIX index, again, that's just the spot VIX price. It's not, you can't trade that. It looks at the options on the S&P 500 index, those index options, all up and down the chain. So it looks at calls, it looks at puts, and it looks at the prices on those. Now, the VIX futures are something that can be traded. But those are, there's VIX futures contracts that expire every month. And, for example, which one is this one? This one is, it doesn't give me the expiration. This looks like it expires sometime in March. Its price was, let's see, 21.5. To give you some context, the spot VIX, the one you see on CNBC, was 21.77 on Friday. That's down, so volatility came back down. And then you go to April, the April contract is about 20.68. You go out to May, 20.51, and kind of drops to June, 20.37. So first things first is the curve is, let's say, the whole curve is a little bit elevated. Now, further out on the curve, when you look at volatility, it does, even if we had a 14 VIX right now, you would expect the further out to be higher. In a normal VIX curve, what you would see if you're looking at a chart and you're plotting all these is that the front end is lower than the back end. It's kind of similar how when people talk about contango or backwardation in futures markets. So we've got an inverted VIX curve right now. And why is that sort of interest to me? Well, it's this idea that if you have an inverted VIX curve, it means that in the short run or the short term, implied volatility or fear, as we sometimes call it in the markets, is higher. And if there's a natural flattening of that curve, it would actually be good for equity markets, because basically what you're doing is when you see the inversion and you see it inverted by some degree, it means if it uninverts or if it goes back to just parity, it implies that whatever the market was worried about in the short term actually is going away. So again, I don't know what's going to happen. If you want to buy the market, you buy the market. If you want to sell it, if you want to short it, that's up to you. But these are all things that typically when you see it, when you see the inversions, at some point, and the VIX can go higher than it's been, but at some point you do, these are potential contrarian bullish indicators that we see in markets. The other thing that sometimes, I don't look at this very often, but somebody sent it to me, and that is what do we call it? The Fear and Greed Index. So I think CNN Business has a chart. It's like a dial, and they say, what are we in right now? And we are in extreme fear. So it goes from 0 to 100. At 100 would be the most extreme greed. At 0 would be the most extreme fear. And as of the previous close, it was 14. So pretty fearful. A week ago, it was 18. Pretty fearful. It's, a month ago, there was fear, not extreme fear. And then it goes neutral, greed, extreme greed. A year ago, we were greed. And what goes into that is it looks at market momentum, something like it's S&P 500, and it's 125-day moving average. It looks at stock price strength, net new 52-week highs and lows on the NYSE. Let's see what else. McClellan Volume Summation Index. So it's kind of a market breadth index. And it basically looks at the amount or volume, and I'm quoting here, of shares on NYSE that are rising compared to the number of shares that are falling. A low or even negative number is a bearish sign. Fear and Greed Index uses decreasing trading volume as a signal for fear. Okay. And then put and call ratio, 5-day average put call ratio. So when you look at a put call ratio, it's sort of the open interest on one versus the open interest on another. And I mentioned before we run that quant strategy that does go long short, does go short at times. That we look at a different one. We actually measure the put and call volume on the SPY ETF. We don't do it on the index. So ours is a little different. And then of course market volatility with the VIX and safe haven demand. So difference in 20-day stock and bond returns. And then they look at a junk bond demand or something or other there. So it's one of these things that, and I'll just tell you anecdotally, what I'm hearing right now is fear. And this is actually a good thing. Why is it a good thing? I don't want people worried about their portfolios. Again, this is why we hedge. The reason why it's a good thing is the crowd typically is wrong. Most people, when they panic, I mean, as Jay likes to say, have you ever made a really good decision when you're panicked? But most people, it goes like this. The markets come down, start selling a little bit more, and then normally at the lows, people sort of get very fearful and say, sell, get me out of everything, go to cash. And typically what happens, again, I don't know what's going to happen this time, but historically, if you look, people tend to get out at the lows. They stay in cash for too long. They miss a lot of the upside. And I think what we saw Friday when the market was up 100 and what did I say it was up? 117 points or something like that. That's quite a bit of a move in markets in one day. And we know that we talked about last week, if you miss some of the best up days and you take out even just the 10 best up days in a year, your return actually historically goes negative. So I'd rather see people stay in the market but be hedged. Stay in the market but be hedged. But just the degree of fear that I'm hearing is, by the way, 117.42 is the number of points. So that's like, what is that? Yeah, that's up over 2% on Friday. So, but just, I think it's a contrarian bullish sign. And the other thing that's kind of interesting to me is on a year-to-date basis, sure, we contracted 10%. We talked about how Peter Lynch in a 1994 speech said, we have a contraction generally once every 2 years. He talked about in 50 years or 50 times contractions of 10% or more over a 94-year period. Again, this is just in 1994. I don't have the updated numbers, but these happen all the time. But we're not really down that much. And I think the fact that we're seeing a lot of fear in markets and maybe some panic setting in, they call that getting the weak hands out. If you're hedged, you don't have to try and time the market. You just want to have protection in place, things that go up when the market's going down, so it blunts the downside for you. The other thing I will tell you is that this seems to be drawn a lot on political lines. We have advisors, we have clients from across the political spectrum. And I can tell you that 4 years ago, the same types of conversations about, Biden is taking over, it's going to be the end of things, we're going to see a depression, a recession, I should probably go to cash. The same thing I'm hearing right now. And it's when you look at something like the sentiment indicator, so the University of Michigan consumer expectations, they call it sentiment. And it's just almost transparent where you look, and if you look at what it has been, 2015 to 2019, so that would have been President Obama, right? That would have been, no, that would have been Trump. Yep. So Republicans were much more optimistic than Democrats. I mean, it was uncanny. And coming into the election in let's see, 2006, 2000, my dates on here are all kind of jacked up. Coming into the 2016 election, Democrats were much more, their sentiment was much higher. So then you look at Biden's term, and I'm looking at a chart of the detailed consumer sentiment indexes by political party affiliation. And Democrats were way more optimistic on a sentiment basis, both in expectations, sentiment, and conditions. Now they have, on this chart, they have a blue line, that's Democrats, a red line, that's Republicans, and then a pink line, or a purple line, pink or purple, one of the two, and that's independents. So then you look and you say, well, what changed? And what changed was it completely flipped. And, to give you an example, a little bit before the election, let's see, consumer sentiment was something like 90 for Democrats and 52 for Republicans. The election happens, it just flips. It just flips. And the recent high was 106.6 in Republicans. Democrats were, what are Democrats? No, sorry, I misspoke there. That was a different one. 86.7 on Republicans and, something like 43 on Democrats. And I will tell you right now, I think the sentiment indicators, we should just throw them out. They are useless. People are doing these based upon their political leanings, and it's absolutely useless. The idea that just because who is in the White House is going to dictate what you think is going to happen outside of the ordinary economy, let's throw this thing out. It's useless. This is a political part. It might as well be a poll. So I bring that up because I do think right now, and it's fascinating too, because some of the conversations I've had, it's when I bring up, 4 years ago, people were saying different stuff. And they say, but this time is different. Well, 4 years ago, I brought up the same thing, and about 4 years earlier, and they said, but this time is different. And is it really different in the markets? Well, markets are always different, and there's things that come up, there's things that people worry about. But in the end, it comes down to, I've said this over and over again, it comes down to earnings. Earnings are one of the most important things. So far, earnings expectations are holding up. Stocks have gotten cheaper on a valuation basis. I forget who put this on Twitter, but I think it's good representation, though. Since 1930 through 2024, the annualized total return of the S&P 500 was plus 9.8%. Plus 9.8%. Here's some of the things that have happened. Great Depression, World War II, Vietnam War, hyperinflation, commodity crisis, real estate and banking collapse, emerging market crisis, Black Monday crash, Asian contagion crisis, tech bubble burst, 9/11 attacks and subsequent Afghanistan and Iraq wars, global financial crisis. Oh yeah, that was 2008, 2009. Pandemic, high inflation, and on and on and on. There's always stuff, and it matters when it matters. So despite all that, I think it's important to give you perspective. Markets draw down a lot. They draw down all the time. I think the average drawdown is something like 8.5%, 9% in markets. And a lot of times markets draw down and they wind up closing up for the year. Now, if I told you that, I guess we drew down about 10.1%. was a minus 8.5% drawdown last year. Market was up over 20%. There was probably a 9% drawdown in 23. Market was up over 20%. Sure, 2022 was down, and the drawdown was, I think, at one point, it's tough to read on this chart, somewhere between 20 and 30% down. And we closed down about 22%, somewhere right around there. So sure, I mean, markets don't always recover. But if you pull up a chart of the eventual full year return for the S&P and you look at the maximum pullback, the lowest pullback, you'd be really surprised. Like, these happen all the time. So I think it's important to keep perspective. And if you are in strategies, if you are invested and you're working with someone and you've got a plan in place, you pick the strategies. A lot of people we work with use our hedged equity strategies. And we try and say, look, I mean, hedging we think you should always be hedged because we never know when pullbacks are going to come. We don't know when black swans will come. And this isn't a black swan. This is just a normal correction. And the benefit there, I think, is pretty clear. It takes away some of the emotion. But I would say for everyone, don't panic. Don't panic. This happens all the time. And as long as you're positioned well, I think you don't want to try and make rash decisions here. All right, a couple more things. Berkshire Hathaway makes a new all-time high. All-time high. So, that I talked about Nvidia having an almost 8% week. Berkshire Hathaway is up, making a new all-time high. S&P 500 post-election cycles versus this year. This is from the Daily Number. Who is this? Grant Hawkridge? It's tough to read. Something I saw on Twitter. And it looks at the actual S&P through, this is through 228. And then every post-election year, 1950 to 2021. Okay, so it's got, doesn't have it has the current one and it has everyone else. And what I would tell you is that according to the every post-election year chart, 1950 to 1921, there was a bump and then a retracement, and then it continued higher. Again, I don't know what's going to happen. This is why we hedge. Ryan Dietrich put this out on Twitter. How often does a correction turn into a bear market? Since World War II, there have been 48 10% corrections on the S&P 500, and 12 turned into a 20% bear market. So just because you get on 10% doesn't mean it's necessarily a bear market. So there's just, I hope this helps give you perspective. So then what are some things that I'm looking at right now? One is we're sort of through the earnings season. Nike comes after the close Thursday. I mean, we're getting really late in the earnings cycle. Micron, FedEx, they're after the close on Thursday. I think those are interesting ones to watch. Nike, because you have the import-export, you have that's consumer. FedEx, it goes back to the old Dow theory, looking at the transports, and Micron. So let's look at Micron though, and I always do this around earnings. They're going to report on Thursday. So what is this? Thursday is that's the 20th. I'm going to look at the Friday, March 21st options. And the Friday, March 21st options, let's see, the 100% moneyness call. Let's see what that is. Oh, I got to look at more strikes. Hang on one second. This is the problem with doing this live. So if I look at some more strikes, let's check the implied volatility here. All right. So Micron closed 100.79. I'm going to look at the 101. That's pretty close. And it has an implied volatility of 112.57. Why is that important? Well, 112.57, we can kind of compute like what does it what's the expectation on a 1-day move, and then extrapolate it out. We take 112.57 divided by the square root of 52, which is 15.875. And basically a 1 standard deviation move, up or down, is about 7% right now. So it's pricing in 7% moves. 7% moves there. So, if you think about that, now earnings aren't Monday, it's not tomorrow. But if you think about, that's 5 days. So the square root of 5 is 2.23 plus 7. I could have just done that in my head. So it's like 9.25% would be a 1 standard deviation move between, now. Well, I'm recording this on a Saturday this week, but over the next week through earnings on Thursday, it's pricing in that much. If we look at the straddle, remember I told you 100.79 and the 101 option, if we take a look at the straddle, and don't necessarily buy a straddle, don't do this at home, but 560 on the call and about 570, I'm rounding there, on the put. So what's that? That's $11.20. So basically, $11.20, that means at 112.20, you break even. So that's almost a 10% move, which is sort of in line with what we saw in the implied volatility. And what do we say? It's like 11.20. So if you did it, if you bought it, what type of move would you need to downside? Well, you take 100.79 minus the 11.20. So between 89.59 and 112 and change, you would break even, basically pricing in a 10% move. So we'll see what happens with Micron's earnings. That one used to be a lot bigger of a deal back in certainly the late 90s. That was one of those that, like Intel, Micron, those were big stocks that people were trading and following. Not as much anymore. Micron's in the computing memory space, not necessarily semiconductors. So, that's a good example, but implied volatility is much higher. If we look, let's go to the mid-April options, the implied volatility is half. It's half. It's like 60 something. So this is an example of options coming into the pricing there. And even something like FedEx, now I'm curious on FedEx to see, because that one is, that one will be an interesting one to watch, at least for the consumer. That's not, let me pull it up. Speaking of other things to watch, the Fed. Oh yeah, the Fed has a meeting this week. So the Fed's going to come out. I don't think, I'm going to look at the implied interest rate expectations. I don't think there's any expectation that they'll actually cut or do anything. Yeah, the March 19th meeting, so that's Wednesday, there is almost a 0% chance that they cut. There's the June meeting has just under, about a 93% probability. And then, the July meeting prices in 1 cut. You actually get to 2 cuts by October. But here, I think the messaging, what Powell says, I don't know if it's a dot plot meeting or not, but this is certainly something that could move the markets. So, and Powell's talked a little bit, and I think he has not said that they'll cut rates. I don't think he's implicitly said that or explicitly said that, but he did sort of hint at, if things change, they may need to change course. So it seems like the market is pricing in rate cuts right now. And that's a change from where we've been. So we'll see what happens. All right, listen, try not to panic out there. All right. These things happen all the time. And I know with especially the news the news is incented to stir you up, to fire you up, to panic you. There was an old saying with CNBC, the greater the dips, the greater the clicks. Like, they get better ratings when the markets are in turmoil. It's just how it is. So try to relax. If you're hedged, just be hedged, and we'll see you all next week. Oh, finish Drive to Survive. It's not it was okay. It was okay. I think what's happening is because now I watch the F1 races, like a lot of stuff I already knew. So, they go through, will McLaren win the Constructors Championship? I'm like, yeah, I already knew that. I know that. So I don't know. There were some good episodes. I think if you don't watch F1 racing, it's definitely worth it. And I did learn a few things, especially when drivers were changing teams, but that's kind of what I was doing, and check it out. All right. Relax, everyone. Take a deep breath. We'll talk to you next week.